Guten Tag, Abi Econ. We have a new video today. It's the bee's knees by the big cheese himself, Mr. Lineker. Let's make history today as we jaw over Unit 3. The first part of macroeconomics. We'll be going over concepts 1 through 3. But first, let's do our daily punishment. A crazy wife says to her husband that mooses are falling from the sky. The husband says, "It's a reindeer." All right, let's get started. As far as macroeconomics, it's the study of a national economy. It's concerned with the allocation of a nation's resources. There's 5 major variables. We're looking at economic growth, which is a steady rate of increased national income. Employment, low level of unemployment. Price stability, a low and stable rate of inflation. National debt, a sustainable rate of national debt. And income distribution, an equitable distribution of income. We're going to first talk about how this is measured. How is national income measured? There's different methods to do this. There's the output method. You don't need to know the formula for it, but this is calculated as adding all the outputs from a country. You have the income method, which you do not need to know for the IB exam, but I did go over it before. You have the expenditure method, which is the one thing you do need to know. The expenditure method measures all the value of all spending on goods and services in the economy. It's calculated by summing up the spending by all the different sectors in the economy. You take all the spending by households, which is C, consumption. Spending by firms, known as investment, which is I, investment. Spending by the government, G, government. And then you take all the exports, you subtract the imports, that's known as net exports. You add those together, and that will get you the GDP, gross domestic product. The gross domestic product is defined as the total output of all economic activity in a country, regardless of who owns the production assets. So, for example, an India company operating in Canada would be added to the Canadian GDP. It's everything within the country. Where GNI and GNP, for that matter, are defined as the value of all the residents of a nation, no matter their location. So GNI is better at looking and helping understand national income from with multinational companies and stuff. They might not be located in the country of origin. The way you calculate GNI is you do GDP plus income flowing into the country minus income flowing out of the country. That is a formula you need to know. Here are some things not included in GDP. Used goods, secondhand goods, gifts or transfers like Social Security, stock, equity, security purchases, unreported business activities, illegal activities, financial transactions between banks and businesses, intermediate goods, so like the glass panels used to put in cars will not be counted because when you count the sale of a car, it would include all the different input prices. And non-market activity like volunteer, family work, babysitting. Let's talk a little bit about what nominal GDP and real GDP are. GDP is often used to measure the growth within a country. We'll get to that formula later on. It can be deceptive though. GDP can rise or fall even without economic growth. A lot of this is due to inflation or deflation. Nominal GDP allows us to look at GDP using a constant price. Real GDP, which is the more important number, is nominal GDP, and then you adjust the inflation. This is done using the GDP deflator. We're going to get to some formulas that you're going to have to know in just a second. You need to know that you need to be able to distinguish between current and constant pricing. Current pricing includes inflation, whereas constant has it removed. The same process is also done for real GNI. Real GNI is nominal GNI adjusted for inflation. So here's the first formula to know. Well, I mean, this is like the third already. So real GDP GNI equals nominal GDP GNI divided by the price deflator times 100. This is something you might have to calculate on your paper 2. It is a formula you need to know. But what do I do if I don't know the GDP deflator? Oh no. I got you. The GDP deflator is nominal GDP divided by real GDP times 100. Probably the more important statistic to look at, especially when we're talking about economic development, is GDP per capita or GNI per capita, because GDP doesn't necessarily tell us a lot if it's a big country, comparing big countries to small countries, but per capita looks at the average income, average GDP per person. And the way you do the calculation for that is you do the GDP and you divide it by the population size, or the GNI by the population size. Here are some pros and cons of GDP. It's easy to compare countries. It informs policymakers and agendas. It gives an indication of average income. It does overestimate the quality of life. It does not account for inequality of income or disparity. There's a lot of things it does not take into account, like education, life expectancy, things like that. And we'll be talking about more about that in the next video when we talk about equity and income distribution. The next thing we're going to talk about is the business cycle. The business cycle is the periodic fluctuations in an economy, activity, measuring changes in real GDP. On this axis, you have real GDP. On this axis, you have time. You do need to know this graph. It goes up and down, just like business cycles. You have contraction when it's going down, trough, expansion, peak. During the trough, you're usually in something called a recession. A recession is decrease in GDP growth for 2 quarters. It follows a cycle of boom, recession, trough, and recovery. It's based on aggregate demand. And like I said, 2 quarters of negative GDP growth. We also have the actual growth right here, which is like the whirly thing. And the potential growth right here is where the economy should be going on average. And you do need to know the difference between that. This right here is a cute little chart over the economic growth, talking about inflation and some of the economic goals. We're going to start talking about aggregate demand and aggregate supply now. It's going to be one of the big things we'll talk about for a good rest of this video. So in microeconomics, we had price and quantity. Demand was downward sloping. For macroeconomics, we have price level, which will allow us to look at inflation, and we have real GDP on the other axis. It is downward sloping also. For aggregate demand, it's the total spending on goods or services in the period of time at a given price level. It's downward sloping. It shows a relationship between average price and real output. And the law of demand does work on aggregate demand. Here's an aggregate demand line. It is downward sloping. We have AD, P1, Y1, etc. These are the things that will cause the determinants of aggregate demand. All of these things right here will cause it to shift. They're all components of it. We're going to talk about the components of it and then what causes the shifts. Consumption is the total spending by consumers on domestic goods and services. You can have durable goods and non-durable goods. Durable goods are goods used over a period of time. Non-durable goods are used up immediately. You do need to know that. Investment is defined by the addition of capital stock to the economy. Like this is like factories buying more resources, building more machinery. It's not capital in terms of stocks or anything. They could do replacement investment when they spend on capital in order to maintain the productivity of their existing capital. So they buy a new copy machine. Induced investment occurs when firms spend on capital to increase their output. So they build some more stuff to try to produce more. And this is different than savings, like I said. Government spending depends on a variety of factors. It could be like spending on government programs and taxes, increases or decreases, health, education, law and order, safety, security. And we have net exports. So exports are domestic goods and services that are bought by foreign countries or foreigners. This causes an inflow of revenue. Imports are goods and services that are bought in this country from foreign producers. This causes an outflow of revenue. So when we look at net exports, we do exports minus imports. So we might get a positive number or a negative number when we're calculating GDP. If it's negative, it will take away from GDP. It will take away from aggregate demand. All right, so a change in the price level will result in a movement along the AD line. Like we said here, it will not cause a shift. But we're going to talk right now about the non-price determinants for aggregate demand. The first one is consumption. And there's a lot of things that could cause aggregate demand to shift because of consumption. Increased consumer wealth, decreased consumer wealth, consumers having higher expectations, consumers having less expectations, household indebtedness, decrease in household indebtedness, less taxes for consumers, more taxes for consumers, unemployment, less unemployment, interest rates, they'll be more likely to borrow, low interest rates, high interest rates, which would be a decrease in aggregate demand, and future expectations. All of those could cause consumption to shift, which would cause aggregate demand to shift. Next one, gross private investment. Interest rates could affect that also, whether businesses will take out loans or not. Expected returns. And expected returns are based on future profitability, technology, degree of excess capacity, business taxes, and corporation indebtedness. Government spending. More government spending will have it shift to the right. Less government spending will have it shift to the left. And net exports. If you have a strong dollar, this is under the foreign exchange market, there's going to be, our goods will be relatively more expensive and aggregate demand will shift to the left. If American dollar depreciates, our dollar is worth less, our goods are relatively cheaper, and aggregate demand will shift to the right. Relative income, if if there are strong foreign economies, there's going to be more exports, so they'll shift to the right. If your trading partners are going through a recession, they're less likely to buy your goods, and it'll shift to the left. Changes in trade policy, so when we get to the next unit, over protectionism, all of that will affect net exports and will also shift aggregate demand. We're next going to talk about aggregate supply. Aggregate supply is going to include short run and long run. It gets involved also with the supply side policies, which we'll talk about next video. It's defined as the total amount of goods and services that industries and the economy will produce at every given price level. We're going to make an important distinction between short-run aggregate supply and long-run aggregate supply. And remember, for this, you do need to know the neoclassical and the Keynesian model. And we distinguish between short-run and long-run. We're talking the neoclassical model. The Keynesian does not have a short-run aggregate supply. It only has a long-run aggregate supply. So let's start with short-run aggregate supply. Short-run aggregate supply is upward sloping, just like the micrograph. It's the period of time when the prices of the factors of production do not change. Price of labor is fixed. In the short run, there's an increase in output. There will be an accompanying increase in average cost. This goes back to the law of diminishing returns, which we've talked about before. Marginal and average costs will rise as output increases in the short run. Here's SRAS. This is a neoclassical model. You have price level real GDP, P1, SRAS. We're going to talk about the things that cause shifts in SRAS. This is, know that there's a relationship between the average price level and the level of national output. A change in price, similar to micro, will only lead to a movement on the line. But we're going to now talk about the things that will cause shifts, the non-price determinants. So input price, so production cost. So like if wages go up, that's an input cost. That could cause a leftward shift in aggregate supply. Cost of capital, cost of raw machinery, all those things can cause input prices to increase or decrease, which will cause a rightward or leftward shift. The value of a currency can also cause a shift in aggregate supply along with aggregate demand. It's really kind of cool. If you have a strong dollar, even though that could hurt your net exports, it could help you buying products from other countries for resources in order to used in the factories to make your final product. So if there's an increase in resource prices, it will shift to the left. If there's a decrease in resource prices, like if your currency appreciates, it will shift to the right. Next one, total productivity. Productivity is total output divided by total input. When it's More productive, it's lower unit of production cost. It'll shift to the right. Less productive, it will shift to the left. Legal institutional environment is the last shifter, the second to last shifter of SRAS. Taxes will cause SRAS to shift to the left. Subsidies will cause it to shift to the right. If you have more government regulation, it will shift to the left. Less government regulation, shift to the right. And we also have supply shocks. A supply shock is an unexpected event, an event that drastically alters supply, such as a natural disaster, war, the supply chain getting messed up, basically. And this will cause a decrease in supply, and it's usually pretty severe. The next thing we're going to talk about is long-run aggregate supply. Long-run is a different, long-run aggregate supply. There are different versions of it. In neoclassical Keynesian, it looks different, but its basic ideas are the same. The long-run aggregate supply is the belief in the efficiency of market forces and their view that the economy, there is a natural rate of economic growth. LRAS is perfectly inelastic at full employment, the levels of output. Full employment does not mean we have no unemployment. Potential output is based on the quantity and quality of the factors of production and not price. We're going to talk about some of the different versions of the long-run aggregate supply. In the Keynesian model, there's 3 phases. The Keynesian graph is at first perfectly horizontal. At this part, if aggregate demand increases, the price level will not increase. If you're in stage 1, you are in a recessionary gap. Once you get to stage 2, right about here, you are at full employment. At this part, the spare capacity is starting to be used up. And if you increase aggregate demand, it will cause an increase in the price level along with GDP. Once you get to stage 3, you cannot increase the real output at all. The GDP is maxed out. The only thing that increasing aggregate demand would do would be increasing the price level. So as resources are used to maximum potential, there will be demand for more resources. And as output increases, this will cause aggregate supply line to become more inelastic. When the economy is at full capacity, what I basically just said, it's impossible to increase any more output further because the factors of production are all fully employed. Once this is achieved, we can't get any more output without a change in the production possibility frontier, without a shift in aggregate supply. So like a rightward shift of aggregate supply would allow you to get more. So let's talk about the shifters for LRAS. For shifting LRAS, you could either use a production possibilities curve, you can use the Keynesian model, or the neoclassical model. This is potential growth. This is long-term economic growth. This is not a short-term thing. This means that the economy has fundamentally changed in potential growth. And some of the things that cause shifts in LRAS are changes in the quality and quantities of factors of production, technological improvements, increase in efficiency, and changes in institutions like a new stable government, a worse government, an adoption of the capitalist system, increase in human capital. All those things will cause major changes. This graph right here just shows the things that cause shifts in LRAS. When we get to our supply side policy in the next video, supply side economics really tries to focus on increasing long run aggregate supply. They do this through interventionist policies and market-based policies. All right. So just to sum up, in the long run, it's the period of time where input prices are completely flexible and adjust to changes at the price level. In the long run, the level of real GDP supplied is independent to the price level. The long run aggregate supply marks the level of full employment in the economy. So the aggregate demand, short run aggregate supply, and long run would all intersect. The short run aggregate supply is the period of time where input prices are sticky. John Maynard Keynes came up with the idea of sticky prices, that like there are some times where the economy gets stuck in a rut and prices are sticky. Because of that, the government needs to get involved. In the short run, the level of real GDP supplied is directly related to the price level. So the economy is deemed to be in the short run where aggregate demand, SRAS, and aggregate demand, AD, intersect. Since aggregate demand is equal to short run aggregate supply, there's no upward or downward pressure on the price level, meaning there's no inflationary or deflationary pressure. This only holds true if nothing changes to influence the equilibrium. So here we have the short run equilibrium. You have SRAS, AD, Y1, P1. For full employment, however, full employment using the neoclassical model is where LRIS, I would label that P1, intersects with AD, intersects with AD and SRAS. This is full employment. It's the natural rate of unemployment. It is the natural rate where the economy should be. For the Keynesian model, they would be at full employment at AD1. At AD, they would have a recessionary gap. At AD2, there would be an inflationary gap. And you do need to know the recessionary and inflationary gaps for both the Keynesian and the neoclassical model. For the neoclassical model, if SRAS and AD were right here, it would be a recessionary gap. If it was right here, if they intersected right here, it would be an inflationary gap. So long-run equilibrium is when the aggregate demand is equal to the long-run aggregate supply. So we will distinguish between neoclassical and Keynesian right now. So right here on this one, they are not at long-run equilibrium. This is a recessionary or deflationary gap. It would need to get like to right here to be at equilibrium. Right here, aggregate demand is it is at full employment. It is at long-run equilibrium. You don't have to, but I would definitely include the short-run aggregate supply graph also. That's just weird. But it is at full equilibrium. For neoclassical beliefs, the economy will always move towards long-run equilibrium at full level of output. So if there's a shift in aggregate demand, like a rightward shift in aggregate demand, then short-run aggregate supply will shift as well. And then it's just going to get back to the current real output, but it's only going to cause inflation. And let me show you what that looks like right here. So in this model right here, aggregate demand shifts to the right. This causes the price level to go up. Because the price level has gone up, there's going to be an increase in input cost, according to neoclassical beliefs. The businesses will produce less, so there'll be a leftward shift of short-run aggregate supply, which causes input prices to go up even more, the price level to go up even more, and we're back to our former real output. So under neoclassical beliefs, Keynesian policy of trying to shift aggregate demand is kind of pointless. It doesn't serve anything. It only causes inflation or deflation. And if you look right here, this did create an inflationary gap. Just so you know, like this right here is a deflationary, recessionary gap. All right. So next one right here, a recessionary gap is the economy is at equilibrium level, is less than full unemployment. So for example, if aggregate demand decreases, the current thing is now a recessionary gap. So then we would have to do some kind of fiscal or monetary policy to have aggregate demand shift to the right, at least according to Keynesians. But neoclassicists would believe that eventually the economy would return to the real output. So just further understanding the neoclassical perspective, no matter if there's a deflationary or inflationary gap, the market will always move towards a long-run equilibrium. Market forces will always push the market towards a long-run equilibrium. Deflationary or inflationary pressure may persist in the short run, but in the long run, it will always reach equilibrium. Remember the connection between LRAC and the different gaps and the PPC. Yeah, you know me. From the Keynesian perspective, it's different. In the Keynesian case, The equilibrium level of output is where aggregate demand is equal to the long-run aggregate supply, AS or LRAS. According to Keynesian economics, the equilibrium level of output may occur at different levels. If the economy is operating below full employment, there will be some spare capacity. That's like the stages 1, 2, and 3. This will lead to a deflationary or recessionary gap, where the economy is not sufficient to buy up the potential output that could be produced by the economy at the full level of employment. This is also called the output gap or recessionary gap. Under the Keynesian perspective, there's a situation where you can increase the aggregate demand of an economy, but said change will also impact the APL, the price level. And this will lead to, if you're past stage 1 of the graph, like if you're from here to here, this will increase the price level. As we move towards the more inelastic portion of the graph, we start to experience inflationary pressures as resources become scarcer. From the Keynesian perspective, if the economy is operating at full employment, there's an increase in aggregate demand, then the outcome will be purely inflationary, meaning there'll be no input increase in output, and the only increase will be the price level. This happens because the output can't change without a change in the given factors of production. There's no more resources. Just showing you right here, recessionary gap, full employment, inflationary gap. Here are the different assumptions for the neoclassical and Keynesian beliefs. These are really important. You definitely want to be able to know them. We're going to talk about unemployment and inflation and income disparity last. So for unemployment, it's defined as the following people, the working age population who are without work, available for work, and actively seeking employment. If you're not looking for a job, you're not part of the labor force, and you would not be counted as unemployed. So the formula that you need to know is unemployed people divided by total labor force. The total labor force are people that are able and willing to work and actively looking for a job. There are a lot of people that are not included in the labor force, people in the military, stay-at-home parents, people that are discouraged, people that have like a hidden economy that are like, drug dealers or something. They are not part of the labor force. So here's the formula again. There are definitely difficulties in measuring unemployment. As far as this goes, it's hard to measure as each country does it differently. It can come from those that register unemployed or those who are actively seeking unemployment, so it can be skewed. The benefits that comes from registering creates an incentive which allows for fairly accurate numbers, however. A person who is not entitled to any of the benefits is not likely to register as unemployed. Let's talk about hidden unemployment. Hidden unemployment consists of several different groups of people. It's those who have been unemployed. It consists of several different groups of people. Those people who have been unemployed for a long period of time and have given up looking for work. Those who are working in the black market. Those who are just stopped working for work. Those that are stay-at-home. Those who are underemployed are also included that. So maybe you only have a part-time job. People who are working in jobs and they're overqualified for. So there is a lot of hidden unemployment, underemployment, and you definitely need to know what that term means. You need to know this right now. This is the labor market graph. The labor market graph is looking at individual labor markets. It says here AD, but it's really, I prefer D and S. It really doesn't matter. But you have wages right here and number of workers. We use the labor market graph when we're talking about structural unemployment. So this does represent the entire economy. We can also use this to look at specific labor markets when we're doing unemployment, when we're doing structural model graphs. So we're going to talk about the different types of unemployment now. There are 4 different types: cyclical, structural, frictional, and seasonal. Let's get started. Cyclical unemployment is like when aggregate demand decreases, when you have a recessionary gap, when the economy has negative GDP growth. Cyclical unemployment is what we really look at when we look at unemployment rate. The next three are called structural, frictional, and seasonal. These are all natural rates of unemployment. There should always be some unemployment because of these next three things. Structural unemployment is by far the worst type of unemployment. It occurs when there's a permanent fall in a particular type of labor within the economy. So like, let's say the typewriter industry, and people figure out how to make computers. That would lead to structural unemployment for people that are working at typewriter factories. This type of unemployment tends to result in long-term unemployment, as it's difficult to find a new job with the skills you have if your industry just disappeared. Causes of structural unemployment. And if you look right here, this is the graph we just looked at, and they did this one correctly. I like this one much better. They did S&D instead of AD. It really doesn't matter that much, but S&D is better. And this has the wages and the quantity of workers. This is the labor market graph. Anyways, so the demand might fall for a particular job due to outsourcing, due to changes in consumer taste, and changes in the structure of trade unions. So structural unemployment is different than demand-deficient unemployment. Demand-deficient unemployment is caused by an overall but temporary fall in demand, aggregate demand, which leads to a recession. The expectation with demand-deficient is that the economy will eventually return. With structural unemployment, the entire structure of the economy of that industry has changed. It's permanent, and there's no really going back. We do have some solutions to structural unemployment. Job training is one of the big things for dying industries. Improve occupational retraining. Government to give more subsidies to train for workers. Government to provide tax breaks to relocate workers where there are more of the jobs. Government to support apprenticeship programs. All of these solutions tend to have high opportunity cost, as well tend to be only effective in the long run. There are some other solutions that are market-based to reduce unemployment benefits. This will incentivize people to take a job quicker. The reduction of overall government intervention within the market will make employers more willing to hire because they know that they will have more freedom with the workers and how to treat them. So like take away power from unions. There are issues that may arise from this, however. They can hurt those that are at a higher risk for losing a job. And they're more likely to lead to possible maltreatment of workers, and it could lead to lack of equity. The next one is frictional unemployment. Frictional unemployment is that short-term unemployment that occurs when people are in between jobs or they have just left education and are looking for their job. The last one is seasonal. It's a temporary job that's only part of the season, like a lifeguard at a pool, Santa Claus. So theoretically, the labor market may be in equilibrium with no demand-deficient unemployment, but there might be still unemployed people. So those unemployed people would be the people that are part of the structural, frictional, and seasonal unemployment. When the labor market is in equilibrium, the number of job vacancies in the economy is the same as the number of people looking for work. The natural rate of unemployment is comprised, like I said, of structural, seasonal, and frictional unemployment. Lastly, we're going to talk about inflation. So there are some real costs of inflation on consumers and businesses. It leads to loss of purchasing power. If inflation is 2% and you're only charging 1% interest, your interest rate is going to be negative for banks. It can heavily influence savings. If the inflation is greater than the interest rates you get in savings, you're actually losing money when you put it in a bank. It makes economic growth harder. If people don't want to save money, then they may choose to buy fixed assets such as a house or art. This means there's less savings available in the economy for investment purposes. Banks will loan out less money. It can affect interest rates. If inflation is high, it's going to make interest rates negative. It's going to discourage investment. and it will have a negative effect on international competitiveness. If a country has high interest rates, our export goods are relatively more expensive, and there's going to be a decrease in demand for our currency. It could lead to labor unrest. If workers feel that their wages are not the same as inflation, it could lead to civil unrest and uncertainty. This right here is a graph you should know. This just talks about the winners and losers of inflation. So we're going to talk about the measurement of inflation and how it's measured. The most common measurement is using the market basket and CPI. There is another way called the RPI. You just really don't need to know about that. But we look at the consumer price index. The way the works is the government has a market basket of goods, and every month they look at it and see how much the price goes up. The first thing you need to do to calculate inflation is you need to find the CPI for a given time period. The way you do that is to find the CPI is you take the market basket year, you take the market basket current year, and you divide it by the base year, and that will give you a number. So if 2000 is 20 and 2006 is 25, it would be, and we want to find the CPI for 2006, it would be 25 divided by 20. 25 divided by 20 equals 125. If we want to find it for 2000, it would be 20 divided by 20 times 100 equals 100. And this right here just is the same thing. This shows you how to find the CPI for each year. This is a simplified market basket. And then you could do the division if year one was the base year, and this gives you the CPI. The reason we do the CPI is we want to find the inflation rate percentage change. And the way you do this is it's CPI in year 2 minus CPI in year 1 divided by CPI in year 1. I don't really like that because you might compare like 2000 to 2009. I say it's the current year minus the base year divided by base year times 100. And that right there will give you a percentage. So for example, if we were comparing year 2 with year 1, it would be an increase in 25% inflation. That one's easy. We're going to talk about the different types of inflation. You have demand pull inflation. This occurs when there's an increase in aggregate demand, so an increase in consumption, investment, or government spending. This will also increase the real output, but it will lead to, at least under the neoclassical model, but it will lead to an increase in the price level. The next one is cost push inflation. This occurs when there's a decrease in short-run aggregate supply, usually because of a supply shock. This will increase the factors of production, will have a direct result of the price level. It could also be referred to as wage push inflation or import push inflation. Lower exchange rates make import materials more expensive. That's why it's called that. But cost push inflation, sometimes we talk about cost push inflation as stagflation that happened in the 1970s. It is really bad. It leads to price levels that increase, but it also leads to a recession, which doesn't often happen. And it's usually caused by supply shocks. However, we could have some things where we get a spiral in inflation, where it's both a combination of demand pull and cost push inflation, which is just really, really bad. So in this situation right here, we have an increase in aggregate demand, which leads to demand pull inflation. Now there's higher prices, so input costs go up, so short-run aggregate supply shifts to the left. That causes cost push inflation. Now we need to have higher wages, so aggregate demand shifts to the right, and so on, so on. This is an inflationary spiral, baby. So how are some ways the governments might attempt to reduce inflation? Inflation is a short-run problem, and so supply-side policies to increase the long-run supply are not really suitable to cure it. For demand pull inflation, the government could increase interest rates. That would be contractionary monetary policy. They could also decrease aggregate demand by raising taxes or decreasing government spending. Cost push inflation is a little bit trickier. This is caused by a rising cost of production. For demand-side policies, you might have to reduce overall cost through government having little control over things. For demand-side policies, it's a little bit harder because the government has no direct control over the factors of production. The government can raise taxes, but under cost-push inflation, unemployment is already increasing, so you're just perpetuating it and making it even worse. So that's why cost-push inflation is much harder to deal with than demand pull. I mean, you can like cut fiscal policies, and maybe that'll do something, but you're going to have a really bad unemployment problem. Lastly, we're going to talk about deflation. Deflation is defined as a persistent fall in the average price level. There is good and bad deflation. Deflation is not bad because deflation does usually lead to an increase in real output. Good deflation would be like when you have improvements in the supply side of an economy or increased productivity. If there's a shift in LRAS or AS. Bad deflation is when you have a fall in aggregate demand. It will lead to a decrease in the price level, average price level, and a decrease in your money. The other term you should know is disinflation. Disinflation is when the average price level continues to rise, but it's less than the previous year. So 2023, inflation was 6%. 2024, it was 4%. We've had disinflation between those 2 years. Let's talk about the costs of deflation. It leads to unemployment. This is when aggregate demand shifts to the left. Businesses will be likely to lay off workers if aggregate demand is low. If prices are falling, consumers will put off purchases of any durable goods until prices drop further or they stabilize. This is called deferred consumption. The process can also lead to a lowering of consumer confidence, which will have a deflationary effect on aggregate demand. If there's a deflationary period, businesses will be put off from investing until it ends. Anyone who has taken out a loan will suffer as a result of deflation. The value of what they have to pay has gone up. So debtors actually benefit from inflation, but they do not benefit from deflation. And it leads to policy ineffectiveness. Deflation is really hard to cure. Japan had a huge issue with it in the 1990s and the 2000s and the 2010s. And they've just kind of got a hold on it. But it could really be bad for the economy. Like inflation is the big baddie that we usually think of, but deflation is really bad as well. Because one of the reasons that is deflation can make the use of monetary policy ineffective. All right, kiddos, that was all for this video. That is all I have for you for today. We are done. You know what I'm going to say. Until next time, deuces, 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 yeah.